Because you're taking depreciation against your income, you're lowering your tax rate. And so if I'm in a 35% tax bracket and I use cost segregation depreciation to drop me down to a 22%, I'm able to save so much money by doing other things, like converting to Roth retirement accounts. The tax and legal, it's almost like that elephant in the room where nobody wants to talk about it. And well, when you're analyzing deals and you're just getting started, you're focusing on where do you want to invest, how do you want to invest? More importantly, why are you investing, right? Who's investing to change their family tree? Who wants to be who's the person in their family that's changing their family tree right now? A lot. Everybody here has said, I've had it. Here's the traditional way to do stuff. Work for somebody else, make somebody else rich for 40, 50 years. But I want to do something different, and that's why we're all here, right? But the tax and legal piece is, a lot of people handle it on the back end. All right, let's get our taxes filed by April. Let's get everything kind of set up after we buy. But this piece right here, the tax and legal, is so important because you're actually able to generate profits and cash flow using tax strategy, not having to have legal battles or entity structure. So I have the QR code right there. If you use your phone, if you want to get my PowerPoint slides, unless you guys don't already have them, because I'm going to show you some numbers here, and for those in the back may not be able to see the screen as well, you'll be able to pull it up on your phone if you want to look at the numbers. Here's my clicker. Okay. Yeah, introduction on me. I got really into real estate once I learned about the sort of tax strategy. And when I got out of college, I was working at Deloitte for almost 2 years there. And what I noticed was like the rich people, wealthy people, what they were doing was they lived on a different system than everybody else. They would take out 15-year interest-only balloon debt, and then the property, whatever asset they were acquiring, after 10 or 12 years would just appreciate in value. And they would, instead of having to pay the balloon payment, they would just refinance or sell, whatever, and they just lived on a different code. And I made it my mission to help that, not the everyday person, but I want to help the person in their family that wants to change their family tree. So, think about this. So, when you look at it, every single person in this room shares the same trait that we all pay more in taxes than we do for food, shelter, and healthcare each year. So if you add up the total taxes that you pay for federal income tax, state income tax, anybody live in California? Sorry, nobody? Okay, good, all right. Oh, okay. Federal income tax, state income tax, we have sales tax, property tax, usage tax. When you add all those up, they equal more than those 3 items there. And so if we're able to reduce some of those taxes, think of it as your roadmap to wealth. You're driving and you're in your car. What's stopping you? You got tolls, and you got gas stops. That's your taxes. That's the tax man. We want to keep them away from us as much as we can possible, legally. So this is an important piece here, and this is part of kind of the homework that I had people understand, is that it's not about how much money you make, but it's the vehicle and the shape of how you make it. And the IRS has done studies where you could have somebody making $500,000 a year as a doctor, and then $500,000 through real estate, and person A and person B are paying way different taxes. Because it's not how much they make, but it's the vehicle and the shape of form of how they make it. If you make $500,000 a year at your business or as an employee, your tax situation is looking a lot different than somebody who's made $500,000 through appreciation in assets or $500,000 in rental income. So my mantra, what I teach people is, and you'll see kind of my buckets in a little bit here, is how do you convert the bag? How do you take your high earning income potential, the creativity and the unique gifts that you've been given by God to do what it is, the work that we do? How many people are in healthcare? Healthcare, we have realtors, right? We have all walks of life, and you're gifted with those talents. How do you take the talents and you convert that income into passive income assets, right? So it's not about how much money you make, but it's how you make it. And then the key strategy here is, and I probably could have summed this up with 2 sentences, is how do we defer recognition of income as long as possible? So if I have rental income coming in, I have a sale, I have income that's going to hit my books, my P&L. I want to be, in most cases, I want to be able to push that off. I want to defer that as long as possible, But if I have to come out of pocket for something, if I have an expense in my business, I have an expense coming up, I want to be able to accelerate that as quick as possible. So I want to defer income because that means I'm paying taxes, but I want to accelerate any sort of expenses that I might have. This is part of the homework was look at your income buckets. So on the left is going to be that earned or that active income. If I say earned, active, or ordinary over the next couple of days, they all mean the same thing. Earned, active, ordinary income, there's limited ways to reduce your tax liability. So this goes back to that $500,000 a year doctor where their only options, if they're just a doctor, is you have retirement accounts, HSAs, you can have more babies. There's only limited ways for them to actually reduce their tax liability legally. On top of that, they have this thing called, I call it the working man or woman tax, and it's how many people have looked at their W-2 and it says Social Security and then it says Medicare? Well, that's a wage tax that you pay just to show up to work. And how many people think the Social Security system will actually be around when everybody's going to poll? I don't think so. So you have that when you're earned income. And then lastly, the ordinary income, it could be taxed at the highest rate of 37%. So you get, once you get to that 37% bracket, you're like, why am I even working anymore? Because it's 37%, and then if I'm in California, it's 11 to 13, and then I still have the Social Security, so I'm paying 50% tax on every single dollar that I make. I've had people say, oh, I don't really want to work anymore because half of it's going to the government. But over here on the right, the passive income through real estate, what's crazy is you have the ability to offset the income with other expenses or losses. And what we're going to learn is the great part about this is these losses don't even have to be cash flow losses. There's cash flow income. Cash flow is different than operating net income that you report to the IRS. They're two different things. With passive income through real estate, we don't have those FICA taxes. So right away, any dollar that you make in rental real estate, and I say rental real estate because it's important to differentiate. If you're a realtor or you're doing fix and flips, you're in a business of real estate, it's a little bit different than owning rental properties or owning real estate. But we're going to get into that in a little bit. And then last, the appreciation on your asset is going to be taxed at favorable rates. So you're going to have, depending on what your income lies in, you're going to have 0, 15, or 20%, as opposed to that top 37% tax that you might pay if you were to make that money at your day job. And let's be honest, there's nothing passive about short-term rentals whatsoever, but at least most of the time it's better than showing up to work. Everybody agrees with that? Or, yeah? Okay. At least I think so. So one of the assignments and one of the questions that I'll have for you guys at the end is you have to determine what is your after-tax cost of items. And so this would be really helpful if you guys had my presentation so you could kind of see these numbers. But the way I look at this, everybody says, well, what is a tax deduction or what is a write-off? Or I'm going to go on this trip because it's a write-off. Is it free? No, nothing's free. But what a write-off or a tax deduction is think of it as like a coupon that you go to JCPenney or Sears or Kohl's and they'll give you coupons to come buy their stuff. Well, that's what the government's doing for your business and your real estate. They're saying, hey, Ryan, you're in a 35% tax bracket. You make this much money, you're single. Hey, you're in a 35% bracket. That's your coupon. And then you add on my state tax rate, which is 5%. So now I'm 35% plus my 5%. Now I'm 40% coupon. So the government's saying, hey, Ryan, we're going to give you a 40% coupon to go hire more employees, to go invest into real estate, to go buy laundromats, to go do hair salons. Whatever it is that you're going to do, we're going to give you a 40% coupon. And so when I have a $1,000 expense, my after-tax cost is really only $600 because I'm getting that deduction, that 40% deduction for me to go use that asset in my business, real estate, whatever it is. Personal expenses are normally never deductible. If we can convert some of those personal expenses to business use expenses, then we're able to deduct them. And we'll talk about that later. So a lot of people ask what expenses are deductible. And this is just a kind of high level list. You have your, advertising fees, cleaning, maintenance, utilities, legal, professional, repairs, supplies. These expenses here, what's important to understand is that it just has to be what's called ordinary and necessary in your business. So the best example that I have is if I'm a dentist, I have to drive to my dentist practice. That's ordinary, right? But is it necessary for me to have a $200,000 Aston Martin to drive to my dentist practice and back, right? That's where it gets kind of gray, right? It's like, so it has to be ordinary, necessary in your course of business. Well, if you're like a celebrity, you need to have that car because that's going to help you give reps. So it all depends on what your position, what position you're taking. I have 3 different businesses in real estate. Like I have, the CPA firm, advisory firm, a content business, do speaking, guest speaking, and I'm starting to do syndications. Which business do I want to write off my expense in? That's just all I have to figure out. Also, we're going to, here's the other expenses. These are the expenses that I see people miss the most. Travel to the rental properties. A lot of people aren't tracking their miles, their gas, the trips, food, meals while you're there doing business or you're meeting contractors or you're getting bids, whatever it may be. I see people miss those. I'm like, where's your meals at? Where's it at? Everybody's using their phone. I mean, how many people run Airbnb off your phone? Are you writing off part of your phone bill for usage? Are you, the internet that you're using at your house, you're using Airbnb on your computer, are you writing that off? A lot of people pay money for entity formation or legal and accounting fees. Those are all deductible. Market research tools. How many people are using those strategies and those tools to identify markets, guesty, hospitable, even on the management side? Make sure we're deducting those, writing those off. Repairs, CapEx, we're going to get into that just a little bit here. I think I have a slide before that. This is the most important expense for us as investors to understand, and it's called depreciation. And this is interesting because we tend to know that real estate appreciates in value, like it goes up, but the contents and the structure of the building is actually losing value over time. So, your millwork and your furniture and everything inside is actually losing value over time. And so what the IRS does is they give us value for that recovery of our building going down in value. So for long-term rentals, it's going to be 27 and a half years. And for short-term rentals or most commercial real estate, it's going to be 39 years. So, I buy a $390,000 short-term rental, 39 years, that's $10,000 of depreciation that I have. So if, let's say my property makes 100 grand a year, I have $10,000 of depreciation, well, I get to tell the government that I only made 90,000. Thank you. Depreciation up front is going to be tax-free cash, because it's an expense that we get on our P&L that we don't actually have to come out of pocket for. And what's interesting about most long-term rentals in the Midwest, they won't actually show a profit for tax purposes until year 5 or 7, because the cash flow on those things is so low, and you have the depreciation piece there, that they don't even show a profit. The problem with short-term rentals is the cash flow is so heavy. They cash flow a lot more compared to long-term rentals. So we need to get these deductions, we need to get these write-offs in our short-term rental business, because we're doing short-term rentals, we're gonna have more cash flow, et cetera. The last piece here is that depreciation is mandatory. And so when I say this is because oftentimes people will say, well, if I write down my income and I show a loss, it's gonna make it hard for me to get lending with banks. Banks are gonna say, oh, you didn't make a profit. And this is where your strategy and where your marginal tax rate is so important. And I don't even have a slide for this, but I see this all the time, realtors who are just starting off, they might go make $120,000, $150,000 in their business and then go buy a $60,000 car. And so they're making money, they just bought a car, but then they go to the bank and the bank says, no, you didn't make 150 grand, you only made 80 or 90, whatever the difference between they made and the car. And so it's gonna make that harder for them to get loans. But you have depreciation coming from real estate, the Fannie and Freddie guidelines say that they're able to add that depreciation back to your income. And so depreciation doesn't change, it should not change your lending ability or your affordability. If your lender is telling you that, you need to work with a more investor-friendly lender that's gonna add your depreciation back. But that piece there is, it all depends on where we're at in our strategy. If I'm leaving my W-2 job at the beginning of the year and I don't know where my income is gonna be at, I don't want to take expenses as much, because how am I going to show income? How am I going to go to banks? Versus if I'm already established, I'm already in that 37% tax bracket, I want to get all the write-offs and all the deductions I can, because I want to be able to save money on taxes. So depending on where you're at in your journey, where you're at as an investor, it changes your decision-making, what you're doing from a tax perspective. This is just an example of a cabin in the Smoky Mountains. You have a $500,000 purchase price here, and what's important is the depreciation is based on the value of the building compared to the land. And so that's important because where you buy can be really important if you're trying to optimize tax strategy. And Kenny and I are going to get into that later as far as where do you look when you're shopping for tax benefits or you're looking for tax benefits. We never invest into real estate just for the tax benefits. It's like that cherry on top. But if you are investing for tax benefits, we have content, we have material for you. So this example here, this property is going to gross revenue $80K. Let's just say our total expenses are 60% of revenue. NOI, my net operating income is going to be 32 grand. My depreciation here is going to be 11,500. Weird math because this is just like a real life example. So straight from the script. So I get to tell the government, no, I didn't make 32 grand. I only made 20,462. And so what did I save here, right? I saved 11,000 times my 40% tax rate. I just saved 4,500 bucks and I didn't even have to do anything out of pocket, nothing. And in this example, my down payment plus my closing costs, let's say I'm in 25%, my year one cash on cash here is 26%. But again, back to the defer income as long as possible, accelerate expenses, I want to be able to speed that up, right? And that's where the cost segregation study comes into play here. And the craziest thing about this, guys, I'm not joking. So I introduced cost segregation study at Bill's boot camp it was here in Nashville last year, October 2nd was the date. It was October 1st because it was the day before my anniversary. So I had to make the trip work out, But I asked, the room was probably about it was either 80 to 90 people. And I said, how many people have heard of a cost segregation study? And there was like 4 people that raised their hand out of a room of 80. And the only person that actually done one at the time was John Hodge. I don't think he's here right now, but. So it's like in a room of 80 people, only one person's ever done it. And then when I spoke in Nashville, did anybody go to the STR Wealth Conference in Nashville? Yeah. When I spoke there, like half the room raised their hand. Out of a room of 850 people, half the people knew. And so it's been this, sort of trending topic, and I want to make sure that I'm doing it justice by introducing this concept here. But the way that I've just seen it pick up momentum and speed over the last couple of years, it just really goes hand in hand because people are trying to set themselves up for success, leave their W-2 job to do this thing full time, to build generational wealth. And depending on where you're at, the cost segregation study can help you get there 100%. So in this example, what happens with the cost segregation study is your building is made up of different components, right? So you'll have your furniture, your millwork, you'll have cabinets, countertops, you'll have everything inside of that property, but normally everything's being depreciated over 39 years. But what that study will do is they'll look inside of your property and pick out the items that can be immediately expensed. As long as something has a useful life of less than 20 years, it can be immediately written off against your income that year, against your rental income that year. And so most of the time you'll see on average between 20 to 25% of the purchase price being written off in the first year. And that's super powerful. In this example right here, again, same numbers, net operating income, 32 grand, depreciation from the cost segregation study, 112,500, taxable income, 80,500, negative. So nothing changed here. My net 32 grand still hit my bank account, cash flow. But instead of telling the IRS I only had a $20,000 profit, I'm telling them, no, I had an $80,000 loss. And what happens to this loss is, it goes back to one of my first slides, is this loss with nothing else, doing nothing at all, can be used to offset my other rental income. So a lot of times I'll see investors, they'll have 3 or 4 long-term rentals, they've seen that gig, the cash flow sucks, they get into short-term rentals. Well, this loss here on your short-term rental can be used to offset your other properties that you've already are cash flowing heavy on. It can be used, and so my sort of concept and theory is, if I can convert all my income from that earned bucket to the passive bucket, it's just a quick calculation of how much passive income do I have coming in every single year. Okay, I have $250,000. I need to match that up with $250,000 of depreciation. And then that tells me how much real estate do I need to buy every single year in order to not pay taxes. And I'm just running that same formula every single year until I'm extremely wealthy. So this example, my year one cash on cash here is 26%. I add in those tax benefits there, and now this cash on cash changes to 48%. So I'm able to boost my cash on cash year one 20% plus, and this is just scratching the surface. I mean, depending on your tax rate, your income that year, I mean, I've seen people be able to boost their cash on cash by 30, 40% in year one using these strategies that we're gonna get into here. But like I said before, the golden rule, do not invest solely based on tax benefits. Do not invest, because what you'll find is that people will lower their criteria for deal search. They'll say, oh, I don't need that 25% cash on cash anymore. I'll take the 18% plus the tax benefits, right? People do that. Or I don't need that 30% cash on cash return anymore. I'll take 20 if I can get my tax benefits. Be very careful doing that, because if you're snowballing not so good investments that don't necessarily meet your criteria, you're just gonna keep finding yourself doing that. And then you have underperforming assets. So I always lead this sort of piece by saying is, again, it all goes back to your strategy, what it is you're trying to do. But never give up that cash flow, that cash percent return for tax savings. It definitely adds an interesting concept there, but never lower your investing criteria just because you're getting tax benefits, right? Because otherwise you'll be snowballing not bad deals, but you'll be snowballing deals that are not fitting your criteria. So a lot of times people will ask, well, when does a cost segregation study actually make sense? And the reason why this is because the depreciation piece, remember how I said it's mandatory? Well, at some point you do have to pay it back, okay? So the depreciation is, you could think of it as like a loan from the government, and you're gonna pay it back at some time. So some people decide, okay, I'll stretch that loan out over 39 years normally. Other people are like, let me front load that loan in year 1 through year 5, and then I'll pay the rest over the 39 years. So to me, a cost segregation study makes sense when you're at a 22% marginal bracket. So if we go back to that first slide there. And the way the brackets work is we have a progressive tax system here. And so it's not like all your money's taxed at 22%, but it's once you're at 22, any dollar that you make over 22 is taxed at 22 until you get to 24. And then all your money is taxed at 24% until you get to 32. So the 22% bracket, the drop down there goes all the way down to 12. So you don't really want to, you could zero out your income completely and say, no, I don't want to pay anything in taxes. But you really want to find that sweet spot. Most of our investors are going from 35 or 37 down to 22, and that's where they're stopping. You may not want to take all your tax benefits up front. You may want to defer those tax benefits a little bit down the road. So 22% is where I start, right? If you're just starting off, you quit your W-2 to do 1 or 2 short-term rental properties, and your tax bracket is only 10 or 12%, you may not want to be accelerating depreciation that year, because now you could be making more money in the future. And so where you would have only paid 10 or 12% this year, next year or 2 years, 3 years down the road, whenever you're making a lot more money, you could find yourself in a higher tax bracket. And so a lot of people kind of itch themselves out of that because they'll find themselves in higher tax brackets in the future. Again, it all depends on where you see yourself. If you're a 35, 37% tax bracket folk, you want to have those deductions and those expenses. But if you're just getting started and you need loanability and financing, you may not want to accelerate as much or write as much stuff off against your income. Lots of rental income or gains. And so this is what's important about real estate is all of them are passive activities. So, and you'll see this, I believe, in my next slide here. You have a lot of rental income or gains. So maybe I just sold a long-term rental, or I sold a property. Well, if I don't 1031 exchange, which we'll get into that, how do I get out of that tax efficiently? Well, oftentimes what you're able to do is, hey, as long as you take that chunk of money and go reinvest it in a different asset, you're gonna be able to offset your income or your capital gain on the first property. The way I say it is, it's like robbing Peter to pay Paul. It's like, I have this sale here, I made money. As long as I reinvest it into real estate, I'm going to be able to offset the gain, right? But there's that, in order to save the money, I have to reinvest my money that I made, right? You have to do what the government wants you to do. And that's what's interesting about the tax code is, who writes the actual tax code? Congress, right? Congress writes the tax code, the IRS just enforces it. And when you see that Congress is made up of what? Business owners. What did it say? Congress is made up of business owners, investors, and people who own real estate. And so no wonder they write the tax laws to favor business owners, investors, and people who own real estate, right? When you see these type of rules, then it makes it crystal clear what they want you to do with your money. They want you to invest it in these assets that aren't going to tax you as much. The last thing here is you want to have a property that has a high purchase price. And I say this because depending on where your asset is, where your purchase price is, determines your tax benefits on that. And so I normally say at about $300,000, $350,000 is where it starts making sense. You'll hear other people say, $500,000 or $1 million, but it depends on what type of investor you are. If you're doing multifamily syndications, if you're doing commercial business here, if you're doing short-term rentals, depends on where your tax bracket is. That is honestly a personal, that kind of one-on-one question there about, hey, does it make sense at this purchase price? And I'm happy to have that conversation with everybody. But your timeline is important because that you have to pay that back at some point piece. So I don't want to buy a property. I know people that do luxury short-term rentals where they will buy that asset, get it stabilized, rent it out for a year, and then sell it to some investor that just wants to be turnkey, hands-off. You may not want to do cost segregation if you're that type of investor that's going to acquire an asset and then sell it a year or two down the road because you're going to end up having to pay that back in 2 years. So depending on your strategy with that particular asset is going to determine whether or not you're going to go through the cost segregation study. With the cost segregation study, what it comes down to is time value of money. So in year one, if I'm able to save $50,000, okay, I'm gonna have to pay that $50,000 back at some point. If I can reinvest the $50,000 of savings, in year 5, that $50,000 is gonna grow to $150,000. So then in year 5, I can pay the 50 back with the $150,000 that I made. That's when it makes sense. But oftentimes too, what I've kind of do consulting for clients that are about to retire is they're making W-2 income and they're making rental income. So their marginal tax rate is at the highest it'll ever be, right? Because they're W-2. So they're up here. So we want to take our deductions when we're at the highest bracket, but when they move on to retirement age, they're not making that W-2 income anymore, so their tax bracket's artificially lower. So that would be a great time to sell off or sell some assets because you're in a lower tax bracket compared to when you're working in your career, you're going to be in a much higher bracket. So just a little history of these type of rules. Before 1986, it was really like the wild, wild west because you could be a doctor, a lawyer, somebody in healthcare, you could be a business owner, make $1 million a year, and as long as you had $1 million of depreciation coming from your rental properties, it would just zero out your income. And so the joke used to be, 2 doctors buy a rental property together, what do you call it? A tax shelter. Because they would buy rentals to offset their practice income, and they finally put a stop. The tax code at this point has been around for almost 80 years. They finally put a stop to that in 1986 where they said, hey, there's this active income sort of component here, your business income, and then there's your rental income. So then they kept those separate. And so what happened is that created the 2 buckets of non-passive and passive income. And real estate, they have the best lobbyists out of anybody, any sort of profession, I think, because real estate agents, professionals, they went to Congress and they said, well, wait, if a doctor has a business that has income and also a business that has a loss, he or she is able to offset that, net those together. But if I'm doing fix and flips, or if I'm wholesaling, or if I'm a realtor and I have rental properties that have a loss, why am I not able to offset those? And that's where this term real estate professional status came into play. And so if you're a real estate agent, a fix and flipper, a developer, a wholesaler, and you're doing that full time, you have the golden cuffs. You have the keys to really, I want to say manipulate, but you have the keys to manipulate what you want your tax rate to be, because you're a real estate professional by trade. You're able to buy pretty much any asset, long-term rental, multifamily, short-term rental, and use those assets to offset your practice income. So I have tons of clients that are realtors killing it, making $500,000 a year. You're single making $500,000 a year, you're paying federally, you're paying $150. You buy rentals, you're making $500,000 a year, you buy some long-term rentals and you're able to offset it. I mean, I have clients that make $500,000 a year and pay zero in federal income tax using real estate professional status strategy. Very cool here. Let's see if I have my next slide. Yeah, so passive losses and how they work. So this is interesting. So this is almost kind of what my tax return, I just finished up my 2021 tax return. And so what's crazy is I was able to do planning. Now I didn't pay zero in taxes, but I had paid in just enough at the extension deadline because I had my income already mapped out. And so when I filed my final return, if anybody follows me on Instagram, it just said zero. It was just, I didn't owe money, I didn't get money back. It was just all was well in the world. But this is how these passive losses work. If I have a long-term rental, it'll net profit $10K a year. I might have a long-term rental that I sold for a profit. And then I might have a laundromat that's passive to me. And that's what's important too, is it's not how much money you make, but it's how you make it. Because if you're a passive business owner, it's a passive activity, which means you can offset that income from that stream with passive losses. If I wanted to invest in Tony's realtor business as a passive investor, that's passive income to me. I just give her money, I don't do any decisions, I just collect a check. That's passive to me. I can offset that income with my real estate losses. Don't have to do anything. Do not have to do anything there. No hours requirement that we're going to get into. It all depends on how you make it. So I have these three assets here. I sold an asset. I have a commercial asset and a long-term rental. They're going to total up $100,000 in profit per year. But I bought that short-term rental and I'm able to generate a $100,000 tax loss from that. Now I'm able to wipe out the profit from my other activities there. And I'm able to do all of this without any hours requirement. I can have a property manager here, I have a property manager here, I have somebody running the laundromat. I don't do that. A short-term rental, I don't do that. As long as my income is all passive, these will all offset each other. And so that's kind of what I've been teaching people, is how to convert convert your income from ordinary business income to these passive buckets as quick as possible. Because here, if I'm paying 40% in taxes, I would have paid $40,000 on this $100,000 profit, right? Zero. I paid zero last year. So some key takeaways here is passive income is taxed less than earned income at a job, right? You're able to deduct expenses against it. You don't have that Social Security and Medicare tax against it. So right away, any dollar that you make in real estate, rental real estate, you're gonna save more in taxes. You're not gonna pay as much taxes than if you were to make that at your day job. The last piece here is the capital gains, or when you're exiting, when that asset goes up in value, we're gonna be borrowing against it. We're gonna be, maybe HELOC depending on our strategy, but there's always an exit plan with real estate. If you dump that money into another asset there, you can defer your capital gain tax bill. So it's just this whole, once you see it, it's one of those things where you can't ever unsee it. And now it's just that conversation of how do I get my income dumped into those buckets, which, remember I brought up the real estate professional piece. The real estate professional piece is, hey, if you want to take rental losses against your W-2 or your business income, you have to be a real estate professional. So I'm a CPA. That does not qualify as a real estate professional, even though I'm a real estate CPA. A nurse does not qualify as a real estate professional because she's not working in real estate. He or she's not working in real estate. A doctor does not qualify. A lawyer, an attorney, they do not qualify for real estate professional status. So how many people have suspended, I was talking to a few people earlier, how many people have long-term rental suspended losses that are carrying forward that they just bank? Yeah. You can't use them until you have other passive income.
But with short-term rentals, there's this exception, and I could throw up the tax code, but that would just bore everybody to death, so I'm not gonna do that to you. But if you invest into short-term rentals and you actually manage them yourself, if you invest into short-term rentals and you manage them yourself, there's a loophole there where you're able to take that loss against your W-2 or your business income. And so we have tons of clients that are, again, in healthcare, high-earning professionals that are able to buy short-term rentals, self-manage them, meet these tests that I'm about to go through, and save a boatload of money in taxes that's able to help them fuel their next steps, their strategy. You know, you wanna acquire 5 to 7 short-term rentals in 5 years and leave your W-2. Each short-term rental is gonna make 60, 70 grand net profit, and you wanna leave your W-2, use that to replace your income. This is gonna help you get there. Because you're gonna be saving $30,000, $40,000 every single property that you buy. It's gonna help you accelerate and fuel your growth and ultimately your exit plan from the so-called matrix of short-term rental. Will boost your cash on cash return. Now, for some people, it's gonna vary. It's gonna depend on purchase price, your tax rate. It's gonna depend on your situation, where you're at. But the short-term rental loophole, again, will boost your cash on cash. So these are the requirements here. So you buy that short-term rental, you have to have an average guest stay of 7 days or less to meet this requirement here. And so if you just add up all your Airbnb, your Vrbo, or your direct bookings, and divide that by the number of unique stays. So if I had 200 days rented, I had 50 different guests, that's an average of 4 days. So check that box, boom, that's most people. And then you have to meet one of these, there's 7 of these tests. And these tests are the same for real estate professionals and people who do long-term rentals. They just look a little bit different. You have to meet one of these 7 tests. So average of 7 days or less, and I have to meet one of these 7 tests here. The 2 that are most common here, guys, is gonna be, the first one is this 500-hour rule. And I call this the gold standard because if you can meet 500 hours in the short-term rental or 500 hours across all your short-term rentals, you're meeting the gold standard rule. And why I call it the gold standard is you don't have to track anybody else's time. Okay, so if I can meet, let's say I have 3 short-term rentals, I can meet 500 hours across those 3 short-term rentals, I'm good, I check the box, boom. But if I can't meet 500 hours, then I have to move down to a lower test. And again, the font, you can't really see it. But it's 100 hours, this test is 100 hours and more than any other person. So if I bought my first short-term rental, let's say I have 1 short-term rental, it's gonna be really hard to get 500 hours in 1 short-term rental. There's only so much to do, especially if you buy turnkey, you're not gonna have enough time. But you can do this 100-hour test and more than anyone else. So that requires me to keep track of other people's time. So I have to figure out how long a cleaner worked, a handyman, a contractor, figure out how much time that they spent because I have to prove that I spent at least 100 hours and more than any other person there. And there is, ever since they came out with real estate professional status in 1993, there's been hundreds of court cases on this topic of what it means to materially participate. And they've gone as back as to subpoena the cleaner, the handyman, the contractor to ask them how many hours did they spend because somebody was trying to prove that they spent at least 100 or more than anyone else. And so your due diligence and your record keeping for this, if this is the strategy you're going to use, has to be crystal clear and clean. You have to track you have to track your hours that you're spending on the property. And the key point here is, and we're gonna get into the hours, I think it's on the next slide. Your hours, you wanna be credible. So one of the court cases I was looking at, they had said that they were at the rental property and they spent 3 or 4 days there. But then the tax court pulled their credit card statement and they were in Europe, right? So not credible there. You say you're at your rental property working on it, physically there, but your credit card shows that you were just in Europe. Not gonna work out, you're probably gonna lose that case. Or another case was, somebody had tried to claim real estate professional status and they were not a real estate professional. They were like a tech person by trade. And they had said, oh, I only worked 1,200 hours at tech and I worked all my other time in real estate, so I qualify. And then they go to the employer and the employer timesheet said that they worked 1,800 hours. So they got paid for 1,800 hours. So are they lying to the court or are they lying to their employer? Either way, not a bad look. So you want to be credible with this. And I couldn't drop it here, but on my website, and I could give you guys, let me know who wants that. I have a time tracker that will allow you to count your hours. It tells you what hours count, what hours don't count, what you can throw in, what you have to throw away. It's just a free thing on my website. But when we talk about the hours here, so by the way, so if you are married, both spouses count. So both spouses are able to add their hours. The key thing here is you're not able to count the same time. So if I'm with my spouse and we're both hanging lights or we're both painting, we cannot duplicate that time there. But if I'm at the basement fixing electric work and she's upstairs decorating, then we can both count our time. That make sense? Stupid, I know, but it's just how it is. So here's just another list of sort of the hours that count. The key piece here is that once the property is under contract is when you can really start counting the hours for that property. A lot of people will go back and forth and they'll say, oh, I should be able to count research time, education time. I should be able to count, the properties that I didn't close. But when you look at the court cases there, they're very strict on when you can and can't count. And in most of the cases, they're not letting people count until the property's under contract. So I have the property under contract, then I'm due diligence, inspector, appraiser, I'm getting lending. Those hours are going to count, but not until it's under contract. So all these hours here, right? So when I'm getting the property set up, I'm meeting there to supervise contractors, that time's going to count. Once I do have the property ready to go, all the management time is going to be able to count. Again, just a list of slides of all the hours that count. If you come across something if you download the template there and you come across something where it's like, hey, does this count or not? Please let me know. Let me ask me so I can research and look it up, because then I'll be able to add it to my sheet, and then we'll just have this long list of every single hour, anything that you can think of. Does it count or does it not count? Because at least probably once a month I get asked, hey, does this count? And I'm like, I don't know. I'll get back to you though. So if you have something that, hey, does this count? Let me know so I can potentially add it to my sheet there. Again, just another list of hours that count. The thing here is what hours don't count. So unfortunately, your travel time back and forth doesn't count. And the reason why is very ripe for abuse. So if I live in California and I invest in the Smoky Mountains and I need 15 hours of time, I'm not gonna fly, I'm gonna drive, right? And so they know that, so they don't allow you to count your travel time. Now, here's what's interesting is, once I'm actually at the property, if I drive to Home Depot and back to get all the furniture, how many times people bought a short-term rental, had a list of stuff that they needed from the store, went to the store, came back, and then figured out that they actually needed more stuff. And then you're making like 2 or 3 trips. Hey, am I able to count all those trips that I took that day?
Not, then that's the question.
Yeah. So you're not able to count travel time to and from your primary residence to your rental, but once you're at the rental, then you're able to count time to the department stores and whatnot. So some common questions that I get around this idea here is, if I buy a property with a partner, not a spouse, but just a business partner, can we both benefit from the cost segregation study? And the answer is yes and yes, yes and yes, yes and no, sorta. So remember, the passive income, we can always zero out our passive income buckets there. And so if I invested in a property with Evan and he's the one that's managing it, doing all the day-to-day there, I'm not gonna be able to take that loss against my W-2 because I'm not the one that's managing that property. But I'm still able to use that loss to offset some of my other passive activities, like my long-term rentals, my commercial activities, and my other short-term rentals. So yes and no. He's going to be able to take the leftover loss against his W-2 income or his business income, but I'm not. That loss is gonna be passive to me. So both people can benefit. It's just one person's gonna benefit a lot more than the other, depending on who's managing it more, right? If you're 50-50, maybe you're 50-50 investment with somebody and you're saying, hey, I'm gonna manage it full time, that's gonna be my thing, you just sit back. That person who's managing it and meets those tests is gonna have a lot more benefit than the person that's not managing it. We kind of talked about depreciation recapture a little bit, but just the pros and cons really is that it's really hard because you don't have a crystal ball. You don't know where your future is going to be. So we don't know where tax rates are going to be in 10, 20, 30 years. They're probably going to go up because our government just printed like $3 trillion. Trillions of dollars these last couple of years. So the tax rates, in my opinion, are going to go up. But what is your income going to look like? What is the structure of your income? And that's important because I'm not taxed on income that doesn't show up on my tax return. If all my income is passive and I'm able to offset that, I don't have a tax rate to even deal with.
And so oftentimes what we're able to do, especially with those clients that are about to retire, is you're paying 37% now, but once you retire, you're going to drop into 12 to 22%. So it makes a lot of sense to accelerate that depreciation up front and then sell your assets or pay the tax when you're only at 10 or 12% rates as opposed to 35 or 37. Can my spouse and I combine our hours? We answer that yes. What are the best areas to buy for tax purposes? That we are going to get into with Kenny in a little bit. But the key piece here is, depending on the area, the location, the market can determine all the tax benefits. So if you're hunting for tax benefits, and that's part of your sort of investing strategy of how you're going to leave your W-2, hey, I need to accelerate depreciation so I can get tax savings so I can eventually get out of my job. So your tax strategy is super important there. There's some areas that are going to be better to buy than others. So for example, Smoky Mountains is like notorious for having super low land value. So people are able to buy cabins in the Smokies and the land value is only 5-10% there, compared to I might buy a property in Gulf Shores where the land could be 30 or 40%. So even though, let's say I had $1 million property in the Smokies and $1 million property in Gulf Shores, one, I'm getting 40% less benefit than the other. It's crazy, but we're gonna get into it. So some other common questions that I get here is, does it matter if I buy the home using a secondary home loan or an investment loan? So the tax man does not care how you acquire the property. They just want to make sure that you're liable for the debt. So it doesn't matter how you acquire the loan, if it's in an LLC, if it's in your personal name, if it's an investment loan. But that's important about your strategy, especially for people who are have DTI, potential DTI issues. Because if you're working W-2 and you're buying real estate, you'll get to the point where your DTI might be maxed out. You might not have any more loan ability. So you might have to move properties inside and out of LLCs, et cetera. So we see that come up all the time. How should I be doing my bookkeeping? When is the right time to hire a bookkeeper? So when I spoke in Nashville a couple months ago, I said, hey, if anybody wants to ask me a question, you can find me on Broadway, just buy me a drink, I'll answer whatever you got. And this guy came up to me and he goes, Ryan, I'm a doctor, W-2, I make this amount of money. I have 7 short-term rentals and it's not enough for me to quit my doctor job. I'm like, you got 7? And he goes, I'm like, where are they all at? Oh, Smoky Mountains. And I'll go, and then he goes, I'm finding it hard to find the time to be able to buy more properties because I have 7 properties that I'm doing. I'm like, you're doing your own bookkeeping, aren't you? And he like did not even respond. He just kind of like nodded down. I'm like, outsource that right now. How long is it taking you? Oh, 2 to 3 hours per property per month. I'm like, dude, that's 20 hours a month that you're spending doing bookkeeping. Like, I don't want to say bookkeeping is low ROI or low level task, but dude, how much is your hour worth, man? How much are you making at your W-2? Oh, making $750,000. Okay, how many hours are you working a week? How much is your hour worth compared to how much time you're spending doing bookkeeping, right? So you have to figure out, what is my opportunity cost there? And I'm like, hey, you free up that 20 hours of time. Okay, yeah, maybe it costs you, $50 an hour, $60 an hour for a bookkeeper, but you free up that time and now you have 20 hours that's 4 hours, 5 hours a week to go find more properties. That's how you're gonna get out of your W-2. Stop doing your own bookkeeping there. And hopefully that'll trickle down to other aspects of his investing there. Same thing about the personal name or the LLC. That's going to depend on your asset strategy, your entity protection, again, your DTI too. You buy it in your personal name, it's going to trip up your DTI. You buy it in an LLC, it's going to be, it could potentially be off your credit and not going to be subject to DTI. So that's going to depend on your strategy. Me personally there, with the LLC stuff, I'm looking at an equity number because we all know, when you buy in your personal name is when you're going to get the best terms and rates. When you buy a conventional in your personal name, or even how many people bought a primary that they've converted to a rental? I've ran that playback 3 times now. So, but you buy it in an LLC or business entity, you're going to get lesser favorable terms and rates than if you were to buy in your personal name. And that, I'm going to talk about that in a little bit about, oftentimes what a lot of people do is will refinance in their personal name before they move it into an entity because they get better terms there. That last question, when do I need a tax strategist? That's going to depend on your bracket. What are you doing for the year? Where you're at in your investing journey. Because I see it really important on the ascension and then the descension. So it's like, how do you acquire, how do you scale your rental portfolio? You're going to want a tax strategist there. But once you get it set up and you understand, you learn the code a little bit, you can kind of pump the brakes on needing to work with somebody maybe one-on-one personally there. But on the descension, how are you going to exit your portfolio? That's also super important of how you're going to get out of these assets. Those are really good times to have a tax strategist, or you could just have them all the time because it keeps me in business. But so some advanced strategies that we're able to implement using this piece here is that because you're taking depreciation against your income, you're lowering your tax rate. And so if I'm in a 35% tax bracket and I use cost segregation depreciation to drop me down to a 12% tax bracket or a 22%, thanks, I'm able to save so much money by doing other things, like converting to Roth retirement accounts. Does everybody know the difference between traditional and Roth? Anybody? Who said it? You know?
No, I know.
Okay. Which one's better?
Roth.
Why?
Because you can take it back tax-free, but you don't get the deduction when you contribute.
Right. So all the earnings in that account are growing tax-free. When you pull it out, it's tax-free, assuming you're 59.5. Or there's some other exceptions, but versus the traditional, all of it grows, it earns and grows, and you pay taxes on the way out, right? So what we want to do here is we want to be able to lower our tax rate, invest into Roth retirement accounts or Roth assets, and then now that is going to earn and grow tax-free for the rest of our life. So where I was in a 35% tax bracket before, I'm able to drop my income down to 12%. I don't want to invest in Roth accounts at 35% because I'm paying 35%. But if I'm able to drop my tax bracket down to 12, I'm only paying 12% to do Roth retirement accounts, Roth conversions. That could easily, just 1 year doing that could easily save me hundreds of thousands of dollars, if not millions, over the course of my life, because now all my assets are in Roth retirement accounts. So I had a client this year where we implemented a strategy where they had $250,000 in traditional assets. They're 35% tax bracket most of their entire life. So when they put that money in, they got a 35% tax deduction. But now it's going to earn and grow tax deferred. They got to pay tax on the way out. What they were able to do is they quit their W-2 job. They didn't have any income for the year except they bought these short-term rentals. And they were able to, with 2 short-term rentals, they were having enough depreciation there that she was able to convert her entire retirement balance from traditional to Roth. And so now she has $250,000 in Roth assets that we were later on able to what's called self-direct your retirement account. So now she's got this $250,000 war chest that's all Roth assets there that she's able to go buy these interesting deals like mobile homes and RV parks and all these creative deals inside of her retirement account by using these strategies. And another one there is those Roth conversions. So Roth conversions is just when you have money in a traditional 401k and you convert it to Roth. You pay taxes when you convert it. This is a great year for that because everybody's 401k is freaking down, right? Everybody's 401k has lost money for the most part. So this is a great year to do that, coupled with if you have losses coming that are hitting your W-2 income, now you're able to lower your tax bracket, convert it over to Roth. I plan on converting we'll see how my account goes. I plan on converting almost $150,000 from traditional to Roth next year using this strategy. That 150, I talked to a guy, I met this guy, I was playing golf with these guys in Scottsdale. And I met a guy that he had a $300,000 self-directed IRA and all he did was buy land in it. Because that's what he knew and understand. You want to invest in what you know and understand, right? Everybody, if you know real estate, if that's your gift, why have your money invested in the stock market when you could do what you know and understand? So this guy had $300K in a self-directed IRA that all he did was buy land, do land leases, and I don't want to say he got lucky, but he got lucky. So he ended up owning a piece of the land that when the Rams came to Los Angeles and built that SoFi Stadium, has anybody been there? It's like the newest football stadium. It's huge. It's like a spaceship inside of the stadium. He owned a piece of land that eventually the NFL bought from him to build that stadium. So his retirement balance went from $300K to $5 million in 7 years. And it was all Roth. It was all Roth. So now he's able to, and he's already over 59. So he was able to withdraw, he went from 300 to 5 million in 7 years, 5 to 7 years, and he was able to pull out that out tax-free because he had Roth assets, so. Or if you just want to sell off assets because you're in a lower bracket, right? If I have a business that I'm trying to sell, but I'm already in a 35% tax bracket, I don't want to sell the business when I'm in a 35 bracket. I would much rather wait when I'm in a 12% bracket to sell that business. So just really creative strategies that once you've taken the time to kind of know and understand what is going on with your tax rate, you're able to do these other really creative strategies that, nobody's really talking about traditional versus Roth retirement, but most of the people are building wealth through their 401ks. Most, middle class, lower income class sort of families there, all their equity, their net worth is tied up in their, whatever they have in their 401k and then their primary residence. So just key takeaways, high earners are able to use this to save 5 to 6 figures. You're able to qualify without having to be a real estate professional, which is super important. And then the last piece there is you want to accelerate tax deductions early when you're at a high tax bracket and recognize those as income events when you're in a lower tax bracket. So I want to accelerate deductions when I'm in a super high bracket. I want to recognize those as income when I'm in a lower tax bracket. Entity structuring around short-term rentals. Question?
Good.
So he had asked, is there a limit on how much you can convert from traditional to Roth assets in a given year? If you're talking 401k, there's not. So if you had a traditional 401k that you want to convert to a Roth, there's not a limit. You just have to be very careful with what it does to your bracket. Yeah. So I see this a lot with clients that are 22, 24% bracket. They convert Roth assets and they might bump to a 32. So you want to get up to that 24, but nothing further. Yeah. Convert the rest next year. Because you're getting up to that 32. That 24 and that 32 is the sweet spot. You want to try not to get up to that 32 if you can. Yeah. But yeah, when you're doing those Roth conversions, there's called Roth conversion ladders, and there's strategies around, hey, it's the end of the year, where's your income at? What do your books look like? How much are we going to show in taxable income? How much can we convert to Roth before bumping you up to that next bracket? So that's the analysis that I'm always looking at, but there is no limit. If a guy said, hey, I want to convert all $1 million right now and pay all the taxes on it, you can do that, but you're going to pay 37% on a portion of that. The entity structure around short-term rentals, if you take anything away from what I'm telling you and on what I'm blabbing about up here today is you do not want to, you want to hold rental real estate, anything that's appreciating value, rental real estate, single family, multifamily, long-term rentals, short-term rentals, syndications. You want to hold these assets in your personal name with a really good umbrella insurance policy, a single member LLC, or a multi-member LLC that's taxed as a partnership. You want to have a single member LLC or a multi-member LLC. If you're working with another investor, me and Evan, my partner together, we're going to have a multi-member LLC. I'm buying properties only by me. I'm going to have a single member LLC for those. We do not want to hold rental real estate, anything that appreciates in value, in corporations, whether it's an S corporation or a C corporation. We do not want to do that because it is very disadvantageous from a tax perspective to do that. I don't want to spill everything and bore you guys to death, but there's taxable transactions in corporations when you're moving real estate in and out. So when you buy real estate and you put it in that corporation, or how many times people have had a single member LLC and the bank wants to, and you want to do a refinance, the bank says, oh, we can't do it to your business entity, it's got to be in your personal name. Is anybody, you're shaking your head, yeah. So if you have that in a corporation, that becomes a taxable event. So I might have a property that I bought for $100K that's now worth $300. I go to refinance, I take that out of an S corporation, I'm taxing the difference, $200,000 difference right there. Nothing happened. I still have that same property. I'm going to have a higher loan payment because I'm going to have a higher mortgage payment, and that will screw some people over. So if you take anything away, rental real estate should never be held in S corporations or C corporations. However, wholesalers, flippers, agents, brokers, if you're in the ordinary course of business in real estate, if you're selling real estate, you want to look at an S corporation as a way to save money on your self-employment tax, that FICA. If you're in Tennessee though, you may not want to do an S corporation. They have what's called a franchise and excise tax, where the tax there at the Tennessee level outweighs the benefits of an S corporation. So pretty much nobody in Tennessee has the S corporation, but long story long. But if you're in the ordinary, I have an S corporation for my CPA firm because it's an ordinary business activity, and we're going to get into the S corporation in a little bit. Another concept here, and this is my first time presenting this, so bear with me up here. Everybody's heard of the Burr method, right? Raise your hand. Everybody, Burr method? Okay. So I teach people to add another step to the Burr method. Well, you're like, oh, wait a minute. There's already 4 R's in there. How many more do you want to add? So what's interesting is expenses on your property, all the costs between when you purchase your asset and when you place it into service are going to be capitalized and depreciated over the useful life of the property. So you sink 50 grand in renovation costs, and you're only going to get a $1,000 a year tax benefit from that because it's being depreciated. And this trips up a lot of investors because they expect that immediate return of, hey, I just dumped 50 grand into renovations here, and you're telling me I'm only going to get a $2,000 a year tax benefit from that? It's because all the costs that you incur between when you buy the property and when you start renting it out, those are going to be depreciated. Available for rent. Whenever the property is available for rent, that's when you're available for rent. And what's interesting about that is when you have the property available for rent, any expense that you have after it's available for rent, that can be potentially deductible. So what does that look like? So you are going to, because if I have the property available for rent, even if I don't rent it out, but it's listed on Airbnb, or it used to be you stick a for rent sign out with your number on it. If I have it available for rent, that means I could start deducting some of the expenses and some of the costs. And so it was like my second property. I had a $30,000 rehab budget here, and I said, okay, I need about $18,000 of expenses to get the property, running water, electricity, whatever, everything that I had to do set up, get it permitted. But that other $12,000 of costs that I had, those were able to be done after I had already listed the property for rent. So instead of having to depreciate those $12,000 in costs, I was able to expense those $12,000 in costs. And let's go back to my tax bracket, 40%. So $12,000 multiplied by 40%, I was able to save myself $4,800 that year just by knowing this concept, just by knowing this. And so what it looks like is you're going to buy the property, renovate it, and it has to be up to city code or permits. You can't list the property when it's on studs or it doesn't have running water or electricity, but you get the property up to snuff and you start advertising it for rent. That's when it's considered placed into service, and now you come in and you start doing some of the cosmetics, maybe some of the painting, some of the adding the furniture, the decor, because now you're going to be able to expense those items as opposed to having to depreciate them. Another thing that's why this is important is cost before the property is live, all of those costs have to be capitalized and depreciated, which means we don't get the benefit of the expense for a long time. Again, 27 and a half years for long-term rentals, 39 years for short-term rentals. We get the benefit through depreciation, which means we have to pay depreciation recapture tax at some point. But if the item is an expense, we write that off on our profit and loss. It's an immediate expense and a tax deduction. And the best part is we don't have to pay depreciation recapture down the road because it's an expense that year and it's not considered depreciation. So it works out really great. Closing costs here, just to let you know, like some closing costs, they're treated differently. So there's 3 brackets of costs. You have some of your costs there can be added to your property basis. And so these are going to be the ones at the top. So like appraisals, inspections, some sort of transfer taxes that you might have, title insurance. You have costs that are added to your what's known as your loan basis. So there's going to be like origination fees, points. You have some costs that are currently deductible. So any sort of property taxes and escrow you might pay, or interest or insurance. This is just interesting to note and kind of like gut check your CPA or your advisor to making sure that they're listing these costs here, because I've seen people miss these, and oftentimes it could be $5 or $6 grand a year that they're missing out on in deductions. So Your closing costs, again, not immediately deductible, but they'll fall into one of these 3 buckets here. So we are going to debunk some LLC myths now. An LLC will save you money on taxes. No. A lot of people think that. You're going to be taxed on a rental property the same way whether or not you have an LLC or not. The LLC is just there for liability purposes. I need an LLC to deduct my expenses. No. You do not need an LLC or business entity to deduct expenses. If I walked outside my house right now and said, I'm Ryan, I'm going to be walking dogs today. I have expenses, I have marketing, I'm able to deduct those costs whether or not I have a business entity or not, okay? So you do not need an LLC to deduct the expenses. I need to get an LLC, I need an LLC to get started. No. And I say this no because a lot of people will get hung up in the paralysis analysis of just how do I get started? How do I get into this rental game here? Do I need this entity? Do I need this? Just get started. And the best story I have for this just happened where I had a friend who's high W-2 job, wants to get in real estate full time to leave his W-2 job. He's like, Ryan, I want to do co-hosting. I want to find 3 clients. I'm going to get $100,000 properties. I'm going to charge them 15%. I'm going to make 45 grand on 3 properties. I'm like, okay. What do you got? What do you got? Well, here's these profit and losses, and I'm going to these owners, and I'm talking, and I got to get my. I'm like, dude, just go start. Just go start. And what happened was he got connected with a lady, and that deal didn't really work out. But she had a friend that owned 10 properties, 10 short-term rentals that were being poorly managed, no books, no anything, no automation, no anything. They were all 100K grossing properties. And when he wanted to have 3 by the end of this year, now he's got 10. And you think that lady that has 10 doesn't know friends that also have probably properties too? And so that's the key there of just not getting hung up, just get started. And so what I'm saying is you do not need an LLC to get started. An LLC will make me bulletproof versus the IRS and creditors. Absolutely not. The LLC will justify that you're in a business activity there, and so you're going to be able to deduct some expenses there, but an LLC is not going to allow me to deduct that $200,000 Aston Martin versus if I just bought it without an LLC. So that's a common misconception. An LLC is easy, right? I just file the paperwork and that's it. No, you have to file the paperwork with the Secretary of State. Every single year you have to re-up, you have to reinstate your LLC, or you have to file paperwork to keep it going. Luckily for me in Illinois, it's pretty easy. They have this form. They say, okay, did you do business last year? Okay, good. Sign your name and pay $75. That's how easy mine is. But some states you have to file a return. Some states you have to do returns, pay taxes. In California, they have an $800 minimum LLC fee. Just have an LLC, $800. If you have an LLC, if you're doing business in California, $800. Terrible. Illinois, $75. But it's cold, so. Also, too, an LLC needs to have a separate bank account and an EIN number with the IRS. So normally what happens is you'll file your paperwork with the Secretary of State, you'll get your paperwork there, you'll go on the IRS website to get an EIN number. Be very careful, depending on your LLC, to make sure you're a single member LLC and you don't sign up as a partnership if you're not a partnership. And then you'll take your LLC paperwork and your EIN, and then you'll go open up a bank account. Each LLC needs to have its own separate books and records. So for each LLC, I need to have a separate bank account with its own books and records for each LLC. A lot of people want to DIY this stuff for LegalZoom or kind of just do it themselves. If you're a solo mission there, if you're a one-man shop, one-person shop, like I set my stuff up, but if you're dealing with partnerships where you're investing other people's money or you're in it with other people, you need to have an operating agreement. If you're a multi-member LLC, absolutely. Even single-member LLCs, the banks will be like, where's your operating agreement? I don't have one, it's just me. I make the decisions, it's just me. Like, oh, we still need to see your operating agreement. I'm like, why? It's a single-member LLC, it's just me. They still want to see it. So especially in a multi-member LLC, you're going to need to have an operating agreement that's going to state the terms. What happens if somebody passes away? What happens if somebody dies? Like, how many people know the difference between tenancy in common and tenancy in, what's the other one? Joint? There's a third one, isn't there? Tenancy in common, tenancy in Entirety, that's it. What's the difference between common and entirety? Common?
Common is just what you put into it, the amount you
Sure. Well, what happens when tenants in entirety, somebody passes away versus tenants in common?
put the survivorship of those
Yeah. That all depends on you. It all depends on your LLC. It all depends on those rules regarding that, what it is that you have going on with that asset purchase or that business, et cetera. So this is a strategy that I was talking about a little bit earlier where equity stripping kind of, before I go to put that property in my business entity, I may want to refinance that in my personal name because I'm going to get better rates, better terms. But also now when I'm moving that equity into a property, there's less at risk there for creditors and people to come after or potential lawsuits. So for example, if I have, let's say $250,000 of equity in a property and I put it in an LLC and then I get sued, well, they can come after that $250,000. But if I have, let's say I refinance and now I only have $80,000 of equity in that property, I'm going to look a lot less appetizing to potential opposing counsel or creditors. Not a taxable event or not a taxable event. So anytime you take out loans, whether it's cash out refinance, although you probably don't want to do that right now, or a HELOC, it's not a taxable event. So that's another interesting strategy we're going to get into is being able to borrow against our appreciated assets, be able to do that tax-free, and to be able to deploy that capital into other business ventures in real estate. Personal use in our rental properties. So who invests where they want a vacation? Who invests where they want a vacation? Well, when you use a property for business and personal use, there's certain rules there. And what I want to key you guys in on is they do not let you have your cake and eat it too. So you can't claim something as a business expense, but then you're also using it personally a lot. And the rule is 14 days personal use or 10% of your total rental days. And you know you're in the tax code whenever a sentence starts with lesser than the greater of. What does that mean? Lesser than the greater, what? Well, it's 14 days personal use, everybody gets 14 days, or 10% of the total rental days. So if I have 170 days rented, then I get 17 days personal use. All good. If I have 80 days rented, I still get my 14 days. All good. Just be very aware of this because if you trip these rules up, they limit you on the deductions and the expenses that you're able to take because they'll say, well, hey, a portion of this property, all these expenses were attributable to your personal use and not your business use. And one of the expenses, the number one expense that they'll try to take away is your depreciation. They will try to take that away if you violate these rules. And so lastly, there is a day where you work at the property for at least 4 hours does not count as a personal use day. So all you people that are like renovating a property for 20 days, you're probably like, thank you. Okay. Yeah, a day where you work there for 4 hours does not count as a personal use day. So what I want to touch on here is, again, the tax man doesn't care how you buy the property. It's going to be taxed the same way, essentially. What's the big piece here is that you get appreciation and depreciation on the purchase price, not your down payment. So if I have $50,000 in the stock market getting 10% versus $50,000 that's invested in $250,000 of real estate, I'm getting appreciation on the $250,000 as opposed to the $50,000. It works the same way with tax benefits. Whether I put 10% down on a property or I buy it all in cash, I still get the same tax benefit. And I did a podcast a couple months ago about the difference between, let's say somebody's got $100,000 and they buy one property, all cash, it's cash flowing heavy, or they take that $100,000 and they buy 4 properties, levered up. What does that cash flow look like? And in a perfect environment, the person who's using leverage will come out 9 times out of 10. But what about when things don't go right? So, just be careful with your leverage and what you're doing, 10%, 20% down. The last thing there is beware of the lender requirements for days use. So some people, when they're buying secondary home loans, what I've seen is the lenders want to see that you're actually using it as a secondary home. And so on the tax return, I wish I could show it, but nobody wants to see that. There's actually a box that says, well, how many days did you use it for personal use? And banks will say, hey, you bought this property as a short-term rental for us, but you didn't stay in it at all. And our requirement is that you use it as a short-term rental. So number one, either you can't go back to that bank that you got the first loan from, or you just have to make sure that you get your days that show up on your tax return there. Another concept we'll talk about is, anybody know that you can buy real estate in your retirement account? That is super powerful because you're able to control your own destiny, right? You invest in what you know and understand. So my guy that does the land leases and only knows land, he's just not investing in other stuff because he doesn't know that. You invest in what you know and understand. And so, you could do a lot with the retirement accounts. You could buy businesses, buy real estate. People buy crypto in their retirement account, although I would never do that. You can buy a lot of stuff in your retirement account, and not a lot of people even know this. And the reason why here is financial advisors don't make money when you take your IRA and buy real estate. It's the same way financial advisors may not make money when you buy real estate. How many times people had an advisor, it's like, oh yeah, you may not want to buy real estate. It's because they don't get paid. They don't get their AUM fee or whatever it is. So kind of find those trusted people that are going to teach you these things of, oh yeah, you could use your retirement account to buy real estate, but who's getting money there? And that's why this concept is not pushed too much, because you have to see who's getting paid. So just some of the pros there is, again, invest in what you know and understand. Your retirement account maintains the same form, whether it was traditional or Roth. And just a little nugget here is, an interesting strategy is if you have a property, when there's a down market, you can get an appraisal on the property and convert your retirement account to Roth, because now your retirement balance is based on the appraisal of the property, not what your deduction was. So a lot of people in 08, what they did was they had all these properties that, yeah, you're sitting there, you're like, yeah, crazy, right? Like a lot of people in 08 that had self-directed retirement accounts, they were able to get an appraisal and convert to Roth. The cons to this though is there's no self-dealing. So you're not really able to kind of manage your property. There's rules on what you are able and able not to do. Most of the time that people that do self-directed IRAs, they're doing them passively. And so they're not the lead partner. They're just kind of like an equity partner or a passive investor there. So I'm taking my retirement account and I'm starting to buy campgrounds and RV parks with it, where I'm just kind of passive, hands off. You could do so many creative things with the retirement account. One of the things that I had a conversation with somebody yesterday about is you may lose out on some tax benefits in the retirement account, because real estate's already tax advantaged in its own way. And if you have the real estate in a retirement account, the depreciation that comes from the real estate, you don't get to use to offset your rental properties, because your IRA is its own taxpayer. And so depending on where your strategy is, you may or may not want to buy in your retirement account. You'd much rather buy in your personal name so you can get the depreciation against your other business income. We'll go back to S Corp. So what is an S Corp, not an escort, okay? S Corp. I had somebody say, what are you talking about escorts in your pocket? I'm like, no. S Corp. What is it and when to use it? When you have an active trader business. Your business is profiting, what do I have there? 60 grand? Yeah, 60 grand a year, it kind of looks there. 60, 70 grand a year. And then the last piece there is, you are in a state that has favorable S Corp rules. So like I mentioned before, there's some states that have these additional taxes. So California, Texas, Tennessee, New York City are kind of the culprits here of it's not beneficial to be an S Corp maybe in those states just because of how they write their state law. But so this is an example of somebody making $100,000 a year net income. Let's say I'm walking dogs for $100K a year net. Okay, I'm Ryan, I'm walking dogs. I'm gonna pay federal income tax $14,000. My self-employment tax is gonna be $15,300. That's if I'm making $100,000 net income and I don't do anything. I set up an S corporation and I pay myself what's called a reasonable salary, a reasonable compensation. So if you're a realtor running an S corp, you know this. I'm a CPA, I know, of course I know this, but you figure out what that reasonable compensation is, and you're able to save in the self-employment tax, because the amount that you take as a distribution from your business is not subject to the self-employment tax. So in an example where I'm making 100 grand a year walking dogs, I'll pay myself 40 grand a year, I'll take 60 grand as a distribution, and I'm able to save $6,000 in I'm able to save $9,000 in self-employment tax just by having an entity. So then you outweigh the cost of, okay, I have to put myself on payroll, I have to file an extra return. And oftentimes people are saving $6,000 to $7,000 net per year for their entire working career. It's super powerful there. So again, back to the whole mantra, how do you defer recognition of income but accelerate expenses? And so the first one we're going to talk about is the cash out refinance or the HELOC. And why I like this one is because of the speed. It's typically you'll kind of send in your W-2s or your recent pay stubs. They want to verify that you have income. You're going to get appraisals on the property. And it's quick to harvest that appreciation that you've built in the property. It's also a non-taxable event that we talked about. So the IRS doesn't deem a loan as a taxable event. So as I'm able to scale my properties and borrow against them, it's not a taxable event. Ownership. I don't have to sell my property. I don't have to give up that cash flowing asset. And that's the difference between people who are fixing and flipping real estate and people who are buying and holding. Because the fix and flipper, they're going to go make $100,000 a year, let's say in profit, between what they all in for and what they sold it for. But then they're going to go pay a 40% tax bill. Versus I'm the person that's buying and holding, I'm going to make that same $100,000 spread there. I'm just going to borrow the difference. So instead of having to pay the 40% bill there, I'm able to borrow the difference there and not have to pay the 40% tax. That's why the code incentivizes owners, not people, not business, not sort of fix and flip or, something there. The other strategy, the 1031 like-kind exchange is, here's where it has to be very careful. A lot of people will jump to this thinking that this is what they need to do every time. Well, it depends. Like, what is your tax bracket? If you're only in a 10 or 12% tax bracket this year, you may not want to be 1031ing anything. You might just want to pay the tax at 10% and then walk away with the cash. Are you in a 37% tax bracket this year? Then you're going to want to defer stuff as much as possible. So that goes back to where you're at in that marginal bracket. The way the 1031 exchange works is everybody's played Monopoly, right? So you have those 4 green houses and then you trade up for the big red hotel. That's how the 1031 works. As long as you sell your property and trade up, or trade for equal or more value, you're able to defer that capital gain. So if I have a $200,000 capital gain that I was going to pay 20% on, that's $40,000 in taxes. As long as I take that money and I roll it into more properties, I'm able to get away from that bill, that tax bill. You have to work with what's called a qualified intermediary. So this is a third party that they actually get paid at closing and not you. So the money will go to their bank account and you'll send instructions to them of where you want that money to go, what are your properties that you identify. And so typically you'll have 45 days to identify your replacement property or properties, and then you'll have 180 days to close on those properties. Now, let's talk about strategy. In a seller's market, this can be very hard to do because those properties that you identify could just be off the market. Depending on where we're at in market cycles determines what sort of strategies we're going to have to use, because I don't want to lock up money in a 1031 and not be able to find a deal or not be able to buy some. Or conversely, what if I locked up money in a 1031 and now I can't find the funding on the back end to go buy those properties, right? Because now interest rates are super high, and we can't really tell where mortgage rates are going to go, but this is super important than just people jumping to the conclusion that they need to do 1031. The timing of everything is super important here, what you're doing. Depending on the market, you may want a 1031 or may not. Last one here is installment sale or seller financing. So this is how I bought my second property. I bought a property from a guy, and he didn't tell me when he sold them, but he's like, oh, I got 7 others and I'm moving. Do you want to buy more rentals from me? And I go, well, my DTI's kind of tripped up, but would you consider financing it to me? And he's like, what's that? I've never heard of that. And I go, let's meet for coffee. Let me talk to you. Let me tell you about it. I go, look, man. I was like, you already have all these sales. You don't want to sell 7 rentals in a year. Your tax bracket will be super high. And you won't have any income after you sell the properties. You'll just have cash. Do you know what you're going to do with the cash? Oh, no. Well, here, why don't you seller finance it to me? And so that's where the seller becomes the bank. And this is going to get a lot interesting in these next couple of months. And this is going to be a lot more enticing. And I don't know if we've already seen it a little bit. Yeah. But the seller financing was where the seller will carry back a note. And that's a way to finance properties without having to go to the bank. But it's also a way to sell. Right? So you're able to sell using seller financing, and you're still able to get that residual income stream. And I've used this strategy both ends, helping clients get out of properties, but also acquiring. It's a huge piece. You come in there with hey, here's the conventional offer at this purchase price, at this high price, what you want. Or, no, here's this conventional offer here, but it's gonna be a little bit less than the purchase price that you want. Or here's a seller financing offer that I'm gonna give you what you want, but it's gonna be my terms. And that's both ends. Seller financing is important to know how to use it to get out of a property and then know how to buy properties using seller financing. Pretty cool. Generating passive losses and the timing of your events. So you do not want to lock up money in a 1031 exchange right now. Because what is it, today's date? November 19th. If I sell a property now, I have the 45 days to identify. That already puts me at December 31st over the year, which means if I don't close on that 1031 exchange, I'm paying the tax. 2022 tax is due April 15, 2023. So right now is not a time where you want to be maybe 1031ing because you have to go through with that 1031 exchange. Otherwise, you're going to be paying the tax bill for 2022. What you want to do is line your strategy up with so you can have multiple options. So what I would say instead is sell that property on January 1st of next year. So that way, if your 1031 doesn't go through, well, now you have 364 days to plan for if your 1031 doesn't go through, rather than selling the property on November 19th and having 5 weeks, including Christmas, to plan for it. What's also interesting here is that timing piece, right? Because if I'm selling a property and I sell it on December, let's say I have a property, $100,000 profit, maybe it's a fix and flip, maybe it's whatever it is, and I sell it on December 15th, the tax bill is due April 15th of the following year. So if I sell a property tomorrow, the tax bill is due April 15th. Well, something as simple as waiting just until January 1st or January 2nd of next year, if I sell it January 2nd of next year, my tax bill is not due April 15th of next year, it's due the following April 15th of the 2024. And so the timing of when you do stuff is equally as important as the types of deals that you're doing, and that's a negotiating point with your buyer, your seller, whatever side of the transaction you're on, to say, hey, you don't really want to sell this asset here at the end of the year. You might want to consider selling it to us in January, right? Because I might already have all the depreciation that I need this year. I need more for next year. So I want to convince the seller to push that back. Oh, hey, and by the way, if we do this sale next year, you're not going to have to stack that income on top of your bracket already. So passive losses, timing of your events, very important there. So this is an interesting strategy. I call it the live and flip. So there's a section in the tax code where they want to incentivize you to homestead. And so basically how it reads is, if you buy a primary residence and you own it and use it as your primary residence for 2 out of the last 5 years, and if you're military, it's 2 out of the last 10, you're able to sell the property pretty much tax-free. If you're single, it's up to $250,000 a gain. If you're married, it's $500,000 a gain. And so I've had friends that have ran this playback a few times. Foreclosures, rehabs, like gut jobs, buy the property, live in it, add the value to it, and then be able to sell it completely tax-free. So if I bought a property for $250,000, I own and use it as my primary residence, and now let's say it's worth $500,000, I'm able to walk away completely tax-free. And this is just a reason why the government incentivizes people to homestead, have families, et cetera. What do I have here? What's interesting about this is 2 out of the last 5 years. So I could have a property, like I'm doing with all my properties here, live in it for 2 years, move out, buy a new one, and I could rent that old one out for 3 years. So I could live in it for 2, rent it out for 3, and then after that 5th year, sell it and still get the tax-free treatment there. Let's see.
Before 5, right?
Yeah, before 5. After 5, you're done. That's it. You have to do it before 5. Yeah. So if I lived in it in 2 consecutive years, I would have 3 years of rental use, and then I would have to sell it. And you don't want to come down to the wire on that, but just keep it close.
Does it matter if you bought it in an LLC or does it have to be your personal?
If it's in an LLC, it's probably not your primary. So I'd be wary of, if it's truly your primary, you probably want to get that back in your personal name rather than a business entity. I'll take questions at the end. I got to get through this, but I'll get you. Income shifting is another strategy too that we've been seeing a lot. So Income shifting is taking your 37% tax bracket income and moving it to other people that have lower tax brackets than you. So like your parents, your kids, people in your family. The why I like this the most is it teaches work ethic. So it teaches your kid how to, what it means to do hard work. And what you're able to do is, I'm Ryan, let's say I'm able to pay my kid $6,000 to work in my business. $6,000 multiplied by my 40% rate, I'm saving $2,400 there. Because my child doesn't have income except the business income that I'm paying him from mine, he has 0% tax on that income. So they get to pick it up completely tax-free. You're getting a tax deduction for it, they're picking it up tax-free. And the best part about this is now that they have earned income, they're able to do a Roth IRA. Because Roth IRAs, retirement accounts are only available to people who have earned income. And so how is a kid that's 13 years old going to get earned income from a job? Nobody's going to hire them. I will in my business, theoretically speaking, right? So now that the child has earned income, they're able to contribute to a Roth IRA. And one of the things about the Roth IRA is that you're able to take out the profits and earnings from a Roth IRA to buy a primary residence. So I have clients that are paying their kid that's 15, 16, 17, building up that Roth IRA, and then so when they're 21, 22, and it's time to buy their first primary residence, what do? They go buy a duplex, live in one side, rent out the other. They go buy a triplex, a quad, all tax-free through this Roth IRA vehicle. And there's also more flexibility with that Roth IRA. You can use it for education, you can use it for medical expenses potentially. There's other things that you can use with that. But this strategy, and again, I have a more in-depth podcast on this, it can be used to really change the family trees because the parent or the business owner is getting that tax deduction for that, and the children are picking it up tax-free, and they're able to use Roth IRA retirement accounts for it. There we go. Some strategies to accelerate expenses. Again, if I'm in a high tax bracket, I want to be accelerating these expenses here. Right? If I'm in a lower tax bracket, maybe, maybe not. We'll see. Bonus depreciation, why I like it is the minimal out-of-pocket costs. You've already done the hard work. You've already bought the property. You've already got it under contract. You've already bought it, placed it into service. And so now it's just doing this analysis of, does it make sense to take the bonus depreciation now? And for 2022 is the last year where we get 100% bonus depreciation. In 2023, it drops down to 80, and then it goes down to 60, and then eventually it's what's called sunsets, and eventually we don't get bonus depreciation. Now, depending on who is in office at the time and kind of how that works out, I could very well see them changing these rules back a little bit because how you incentivize economic behavior, you do that through the tax code. So if we want people to build stuff, produce stuff, work for themselves, we need to incentivize them. So I could very well see them adding the bonus depreciation back on 100%, but we'll see how that works. So you're able to do this analysis of, hey, does it make sense for me or not? And you're able to do that in real time before you make a decision on your tax return. And then of course, just the tax savings from that bonus depreciation. So this could be, again, a rental property, a vehicle in your business, any sort of asset that you buy in your business could potentially be bonus depreciated. Prepay future expenses. So this is super important right now. So we're cash basis taxpayers, which means we get a deduction when we pay for the expense. And the same thing with income. I'm not taxing that income until I actually receive it. So I'm trying to defer all my receipt of payments until January 1st of the following year, but I'm trying to accelerate all my expenses in this year. So if I have contractors, if I have bids, if I have, I have marketing guys that I need to pay, I have supplies, I have all this stuff for my short-term rental that I know I'm gonna need to do from January to March of next year, why not pay for some of that stuff now so I can get the tax deduction now as opposed to getting the tax deduction in the future? Now, don't screw yourself over by doing this, by paying people without them showing up and actually doing the work. But you might be able to negotiate with people, say, hey, I'll pay you 3 months early, but I want a 40% discount. Or I'll pay you, you kind of do this stuff. And why I like about this the most is the flexibility of it, is I don't have to do anything if I don't want to. If I want to hold my cash, if I don't want to do that, I don't have to, but it's an option to, hey, I'm in a high tax bracket this year, I don't know what's going on next year, let me pay for some of my expenses now, I'll get the tax deduction now. Lastly is financing purchases. So one of the most common questions that I get asked is, well, how do I buy a vehicle and use it in a business? What's the best tax efficient way? And so remember I said it doesn't matter if you put 0% down or 100% down, you get the same tax benefits. And so financing, for the most part, financing purchases, so Even they let you finance, what did I see the other day? Like a music instrument. It was like $400. They're like, oh, you can make $39.99 payments. It's like, dude, if you got to finance a $400 instrument, you do not need to be buying that. But with a car, right? If I have a $50,000 car, maybe I put $5,000 down and then I have a 5-year note. I'm putting $5,000 down, $50,000 write-off in my business at my 40% tax rate. I'm saving 20 grand in savings and I only put $5,000 down. And so it's how you work, again, but you got to go back to your bigger picture. If I'm a realtor and I'm making 100 grand, I'm not buying a $50,000 car because the bank's going to say, oh, you didn't make 100 grand, you only made 50 because you needed that vehicle for your business. So it all depends on your strategy here, but just know it doesn't matter how much you put down, you get the same tax benefits and the same deduction there. So me personally, all my businesses are remote for the most part. I just had to start going to real estate investor meetings in Chicago so I could write off my vehicle because I didn't have an excuse to be able to write it off before. So now I started going to these local meetups in Chicago. But that's all that I have here. We went through a lot. We did a lot.